Hello and welcome to this week's great instalment of the Fit Finance Sessions. I'm Henry Elliston and I'm with Tim Webb and Tom Senegals. And today we're going to have a very short chat about Archegos, if I've said that right.
I think so. I don't think anyone knows how it's spelled or how to say
it. Archegos is a hedge fund in America and it's caused havoc across the markets. I don't know why, but I know a man who does. Tom, fill us in.
So I actually think Archegos or whatever it's called means Jesus in some sort of ancient Greek or something like that. But the trader Bill Wang, who used to run a hedge fund called Tiger Asset Management and then got slapped on the wrist, converted his hedge fund into a family office and created this Archegos or whatever it is. But unlike Jesus, he's failed spectacularly. And Bill liked a bit of Bill Wang loved a bit of leverage, and the way he was structuring the portfolio was their long plays, so investing for the long term, were covered by shorts, and they were borrowing lots of money to in some ways it should be a zero sum and they can kind of hedge their bets a bit, but unfortunately they got it a bit wrong, and effectively, from what sounds like it, they've blown up the fund and had to start I think Goldman Sachs and Morgan Stanley have come in and started selling the stocks to cover all the positions, and so a few specific stocks have taken some big falls because they're unloading very big positions. I think the fund was about 80 billion, and it's also knocked banks like Credit Suisse and Nomura who were lending to them. So I think the individual stocks were down about 50% from their highs, and the banks that have been lending were down about 15% yesterday. I haven't looked today, so there's a bit of contagion, but it's not spreading into other things. And it was mostly Viacom, CBS, Discovery, sort of older media companies that had been on a huge tear over the last couple of quarters since the pandemic, but have subsequently flopped. So yeah, that's roughly what's going on. But Tim, do you want to explain why that happens and why the shares do go down?
Yeah, sure. So essentially how it's gone so wrong is the trade was done on what's called a margin, which is where hedge funds normally operate on this basis, and that's why they can have such massive returns. But effectively what they're doing is borrowing to enter a larger position than they can actually afford to get into from Credit Suisse and Nomura, the two guys in this particular example. So for example, let's say you've got $100, to keep things simple, $100, but you're leveraging yourself up and putting that down as what's called margin against a $1,000 position. So you're putting down 10% of the actual position that you're liable for. Now, clearly that can work in two different ways. If the trade goes in your way, then you're magnifying your returns, but then conversely, things can get pretty ugly and hairy on the way down, as Bill Wang's just found out. So that's effectively how it's been structured. Now, at some point, what happens is if your trade goes against you to past a certain point, then the lenders, the investment banks that guarantee these sort of positions do what's called or put through what's called a margin call, where let's say that $100 falls below a particular threshold, which would have been agreed at the outset of the deal. Let's say it's 30%. So now the value of your $100 falls below $70, then effectively the difference, let's say it's got back down to 50, so it's halved in value. Then what they're going to do is ask you to put up more collateral or more cash to bring you back up to that minimum level that the whole trade was done off the back of, and that's what's going on at the moment, where they're being wiped out or being asked to put in so much more to bring the trade back to par value, basically. But I think from reading through in this particular example, I think they had assets of 10 billion, whereas the trader got to the point of 50 billion. So as you said, they've been wiped out. Basically, it hasn't. There's not really any room to come back from that unless somebody wins the lottery or whatever. So yeah,
you win a lot on the lottery there.
Yeah,
Find
exactly.
yourself 30 billion. That's a several lotteries I think you got to win.
Yeah, if everybody in the team in the hedge fund wins.
But interestingly, it's not a sign of wider market contagion. It really is just it's one hedge fund manager seems to have got his decisions wrong and been taking a bit too much risk with it.
Absolutely, but it is interesting. Summary of this certain sort of state of play at the moment. I think it shows that people out there are still, or the smart money, if you like, or maybe not so smart in this example, but the big money out there is still, it's still a lot of risk that people are taking out there. And yeah, as you say, the general market's shaking it off. I think everybody's still focused on the vaccine rollouts and that kind of thing. And as you were saying, Tom, there's only a couple of stocks really that have been affected. Whilst those stocks do make up, in some value in some of the indexes, drawn down too much across the board. I was reading through something. Sorry, go on.
I think that initial sell-off, a lot of stocks that had kind of built some momentum there was sort of, I don't know, you're seeing 25% drops in Tesla and other stocks. And I think some of these were caught up in that initial sell-off. And like you say, lots of people are taking risk. If it doesn't keep going and going, then it starts the spiral. And if you're like Warren Buffett and Charlie Munger would always say, lots of people go wrong when they use leverage. It's good when it's going in your favor, but it can quickly blow you up in the other direction, can't it?
Yeah, exactly. But as I was saying, I just managed to track them down. But I was reading through some interesting stats this morning where, as I say, just backing up this idea that risk is still very much on the agenda and people are still taking these bigger calls. So equities now account for 50% of all assets held by households, mutual funds and pension funds, foreign investors, etc. That's the highest level since the tech bubble two decades ago. Equity options trading is up 85% from 2017. Cash levels are an 8-year low. So people are going for it. Both retail investors, sort of the mum and dad investors, people down the pub, what have you, taxi drivers, but also the professional money is also going for it as well. So, and also here, nearly 51% of investors believe stocks will rise in the short term compared with the historical average of 38. So there's a lot of optimism out there. We've not to go over old news, but obviously we've gone through the various stimulus that's been pumped out there and that sort of thing. But I think clearly a lot of people are focusing more on that side of the economy at the moment rather than these sort of short-term bangs that we're seeing with the hedge funds. And I mean, bad news makes good news, isn't it? So clearly this is going to be something for us to piggyback off and talk about clearly. But yeah.
I don't know what you're saying, Tim. This is a very well thought through article that we've put together with hours of preparation before.
Yeah, highly convenient that Bill's blown it up, isn't it? But yeah, I think again that's why you just got to stay diversified, haven't you, and not pour all your eggs in one basket when it sounds like everything's going really well. And I think there is still a lot of optimism out there. Equally, you can't. It's like inflation. Everyone's forgotten inflation over the last 20 odd years, but that could come back quite quickly. And particularly if people are moving away from bonds and buying more equities, like you're saying, is coming through the data. Governments are raising debt, therefore they need to sell those government bonds. If no one's buying them and people are actually selling, then yeah, it's a bit of a self-fulfilling prophecy.
Yeah. Fascinating as always, chaps. Thanks very much. I now know almost how to pronounce the name of a hedge fund somewhere in America that's no longer existing. As ever, if you've got any questions about this topic or any other topic, please do get in touch, either through LinkedIn or directly email us. And until next week, thanks for joining us and we'll see you then. Bye-bye.